Those two approaches to valuation by far dominate all of valuation, and we'll talk about which one is dominant, but there's a third and final approach to valuation. The third approach to valuation, and this is perhaps the only new and perhaps sophisticated aspect that's new to valuation, is applying option pricing models in the context of valuing these assets that have contingent cash flows. What are contingent cash flows? Well, this asset will have value only if something happens. So if you're a biotechnology company, you have a patent working its way through the pipeline, it'll have value only if you get FDA approval. You're an undeveloped oil reserve company, those oil reserves will have value only if oil prices go up beyond a certain level. So collectively, you can take valuation approaches and break them down into these three basic approaches. Underlying each approach, though, is an assumption about how markets work, or better still, how they don't work. Each of these approaches assumes that markets make mistakes. Saying, why do we need that assumption? If markets never made mistakes, there would be no point to valuing publicly traded companies, right? The market price of the company would be the best estimate of the value of the company. So every one of these approaches makes an assumption about market mistakes, but they all make different assumptions about how markets make mistakes and how those mistakes get corrected. So to set the table on these different approaches, let me give you a very quick introduction into each of these approaches. Let's start with discounted cash flow valuation, or intrinsic valuation. What is it? In discounted cash flow valuation, the value of an asset is the present value of the expected cash flows in the asset. Nothing more, nothing less. You're trying to estimate the intrinsic value of a business based on its cash flows. And if you break down a discounted cash flow model, it has three ingredients. You'll see cash flows, you'll see a discount rate that reflects the risk in those cash flows, and you'll see a life for the asset you're valuing, which could be 5 years, 10 years, it could be forever. And when you use discounted cash flow valuation, you are assuming that markets make mistakes in valuing individual companies and that they correct these mistakes over time.